Today, we are talking about a simple tool you can use to help build your credit score. It is called a secured loan, or sometimes a pledge loan. This is not like a normal loan where the bank just trusts you to pay it back. With a secured loan, you give the bank some of your own money to hold on to first. Diagram: money flows from person to savings. Then the bank issues the loan back. This money is called collateral. It acts as a promise, or a pledge, that you will pay back the loan. Because the bank is holding your money, there is very little risk for them. This makes it very easy for almost anyone to get approved for this type of loan, even if you have a low credit score or no credit history at all. The reason a secured loan helps your credit is simple. When the bank gives you this loan, they start reporting your payments to the credit bureaus. These are the companies that create your credit report and calculate your credit score. Every time you make a payment on time, the bank tells the credit bureaus about it. This creates a positive payment history on your credit report. A history of on-time payments is the most important factor in having a good credit score. It shows other lenders that you are a responsible borrower who can be trusted with money. It is a powerful way to show you are serious about your finances. Let's break down exactly how this works with a real example. This is the method that has become very popular because it gets results quickly. Imagine you have $1,500 saved up that you can use for this purpose. The first step is to deposit this money into your savings account at the bank. This money must be in your account before you can ask for the loan because it will be the collateral. Once the money is sitting in your savings account, you are ready to move on to the next step. This is the foundation of the entire process. So make sure the funds are there and ready to go. Now, you will apply for a secured or pledge loan for the exact same amount, $1,500. You can do this by visiting a branch or often through the bank's mobile app. You will tell them you want a secured loan using the funds in your savings account as the collateral. The bank will then freeze or lock that $1,500 in your savings account. You will not be able to withdraw or spend this money. In return, the bank will give you a loan for $1,500. They will deposit this loan money directly into your checking account. So, to be clear, your $1,500 is locked in savings, and now you have a fresh $1,500 from the bank in your checking. Deposit $1,500 lock-in savings loan to checking. Pay $1,400. Leave $100. You might be wondering why paying off the loan so quickly is so powerful. It seems a little strange, but there is a good reason for it. When you pay back a large portion of an installment loan, like 90% or more, in one big payment, the credit scoring systems see this as a huge positive. It dramatically lowers your loan utilization on that account. It's like you borrowed a lot and then proved almost immediately you could pay it back. To the credit bureaus, it looks like you made many months' worth of payments all at once. It's a shortcut to showing responsibility. This is different from the traditional way. Small monthly payments over a long period. For example, $50 every month for 3 years. Making those payments on time helps, but it takes a very long time to build a positive history. The smart repayment strategy speeds everything up. You get the credit-building benefit of a long-term loan without waiting years for results. After the large initial payment, leaving a small balance, around $100, you then pay off that remaining balance over the next few months. Timing and amount matter. How to maximize your loan's impact. When you set up your secured loan, the amount you borrow is more important than you might think. Simple rule: try to borrow more than $1,000. Many banks, including Navy Federal, have different reporting rules based on loan size. If you take out a secured loan for less than $1,000, the bank may only set it up for a short term, 6 months. That means it will only report to the credit bureaus for 6 months. While that helps, a longer reporting period is much better for your credit score. Short-term loans have less long-term impact. If you borrow more than $1,000, for example $1,500, banks will often give a much longer loan term, 18 months, 24 months, even longer. A longer loan term is more valuable for your credit score because it keeps the account open and reporting positive information for longer. Age of your credit accounts is a factor. An installment loan that stays on your report for over a year is a big advantage. It shows stability and a longer history of responsible borrowing. The best part, it usually does not require a hard credit inquiry. Section 5. Pledge loan versus CD. Knowing the key difference. It is important to understand that a pledge loan or a secured loan is not the same thing as a certificate of deposit, often called a CD. People confuse them because both involve locking up your money at a bank, but they serve completely different purposes. A CD is a savings product. You give the bank your money. They lock it up for a set term. In return, they pay you interest. With a CD, you make money from your savings. It's a tool for growing wealth, not for building credit history. A pledge loan is a credit-building product. You give the bank your money as collateral. They give you a loan. Instead of the bank paying you interest, you pay the bank a small amount of interest. Rates are usually very low, often 2% or 3%, because the loan is secured by your cash. The main purpose isn't to make money, it's to have the bank report your payments to credit bureaus. That reporting builds positive payment history and helps raise your credit score over time. Section 6. How to do this at any bank. A simple guide. The great thing about this strategy is that it is not just for one specific bank. While Navy Federal Credit Union is well known for its pledge loan, most banks and credit unions offer a similar product. They just might call it by a different name. The most common name is simply a secured loan. So if you walk into your local bank or credit union, that is the term you should use. You can walk up to a banker and say, "Hello, I would like to apply for a secured loan." To make the process as smooth as possible, it is best to have your money ready. Before you go to the bank or open the app, make sure the funds you want to use as collateral are already deposited in your savings account. This shows the bank you are prepared and serious. If you are at the branch, you can tell the banker, "I have money in my savings account that I would like to use as collateral for a secured loan. I would like the loan amount to be, for example, $1,500. Please deposit the loan funds into my checking account." These simple phrases are all you need to get the process started. The banker will guide you through the paperwork, which is usually very simple. For even greater impact, you can consider doing this at more than one bank. A good strategy is to do one secured loan at 2 different banks, or do one secured loan at 3 different banks. Having a good history with several banks can open up doors to better products in the future, like credit cards with high limits or loans with low interest rates. It shows the financial world that you are a reliable customer who is valued by more than just one institution. It makes your credit profile look much stronger and more diverse. By spreading your financial relationships across different banks, you can dedicate each one to a specific purpose, one for paying bills, another for long-term investments, and a third for your savings goals.